Hey everyone, me Kevin here. I'm regularly asked how much further down can the market fall and when should we expect a bottom? Folks, we're all looking for a bottom. And the next set of research should be alarming to you, but it should also be used as a tool to prepare yourself, to make sure you're properly diversified and prepared for what's to come in markets, and potentially position yourself the way the research suggests. Because in this market, there are no free handouts while we look for the bottom, with the exception, of course, of Public, who will give you one totally free stock worth up to $1,000 when you go to metkevin.com/public. Go to metkevin.com/public, deposit any amount of money, and enjoy a platform that does not use payment for order flow and has a beautiful social media aspect to it. Check them out, metkevin.com/public. Now, it should come as no surprise to you that Google searches for the phrase recession have skyrocketed at the beginning of this year, and financial advisors' bearish sentiment has been skyrocketing since actually February of 2021, reaching a peak and alignment with Google searches for recession just in the last few months. Well, folks, we're regularly told that there are two things that hold the market up. First are what are known as price to earnings multiples. This is when we look at a company and we say, okay, at the end of the year, how much money is this stock actually going to pay me? And let's say the stock pays you $10, and those earnings could either be in the form of dividends or they could just be in cash that sits in the company or buybacks. Don't worry so much about that. Just imagine you run a lemonade stand and at the end of the year you make $10. Well, somebody might pay you for that business a multiple known as the price to earnings ratio. And if that multiple is, let's say, 20, then the value of your lemonade stock per share might be $200. And what happens in a recession is investors look at this and say, you know what, we just can't afford right now to pay these sorts of multiples, the times 20 here. So what we're going to do is we're going to slice that, and we're instead going to offer you a lower number like 10. Now we're going to take your $10 of earnings, multiply it by 10, a multiple, and now your company is only worth $100. This is an example of multiple compression, how 50% of the share price of a company has evaporated simply because the market is less willing to pay for those earnings. Now, some, like Michael Burry, warn us that the price to earnings crash is only half of the battle, and that we face another problem, and that is the problem of EPS write-downs. Remember in this example, if your stock made $10 and you received a multiple of 10, you would get $100 as your share price. But while we wrote down the price to earnings multiple, what happens if we now have to come in here and say, crap, we're not making $10 anymore because we're in a recession? Well, now, folks, you have phase 2 of a bear market, and that is the write-down of earnings per share. Now, Credit Suisse provides us some excellent research. They say that valuation compression, which is a fancy way of saying price to earnings multiple, that first part, may be complete. And they suggest that now phase 1 of our bear market is driven by deratings on the back of higher rates and recession concerns. Again, fancy, really fancy, big word way of saying that forward price to earnings multiples are now roughly in line with where they should be in a decline. In fact, you could see this here in their price to earnings model, suggesting that the decline in valuations is complete. That we have seen market signals, this dark gray line, align with actual price to earnings projections. This is a very good thing. Again, it means that the first half is complete. However, if you take a look at this chart, we can see that in the 1990 recession, followed by the dot-com bubble, followed by the recession, the Great Recession in 2008, and followed by the COVID recession, in every single one of these instances, we have seen price to earnings multiples decline an average of 25.9%. And by some degree, we've already exceeded that with a decline of 28.8%. But take a look at forward earnings per share projections. In 1990, earnings per share projections, how much your lemonade stand is making, came down 7.9%. In 2000, 17.8%. In the Great Recession, 38.9%. And in the COVID recession, 21.3%, with an average of 21.5% in decline. Well, how much from peak to trough have forward earnings per share declined in the current bear market? Folks, the answer is 0. That means we still have to go through the pricing of a reduction of earnings per share. And all of this is happening at the same time that our recession risks are being complicated by wages continuing to be strong. Employment continues to be strong, as we saw in the June jobs report that just came out in July. We saw that we're still gaining jobs like crazy. We're still seeing wages increase to the tune of over 3.5% every single year on a monthly basis. This trend isn't breaking. We're still seeing more job openings than we would expect. And by some accounts, we haven't actually reduced the fact that there are 1.9 job openings per unemployed person. And this is all being complicated by, take a look at this, wages being stickier because of reduced immigration, less outsourcing by domestic companies, and higher minimum wages. These higher minimum wages being so common because the service economy needs so much more help right now, and folks like airport staffers need to get paid more to be motivated to show up to work or to take the job in the first place. And if you add on top of this inflation risk, the risk that we have inertial inflation, so risk number one of high inflation being wages continue to expand and continue to grow, making the Fed aggressive, essentially guaranteeing us that we're going to get larger and more aggressive Federal Reserve hikes. On top of that, we have the risk of inertial inflation, which is the inflation that we get when real estate forces people into renting because mortgages become so expensive, which drives up the costs of renting properties, which increases the owner's equivalent rents, which increase CPI or inflation again. So, in other words, we have this disastrous situation where we've only gone through about 50% of the derating. So 50% derating is, not debating, although some might debate this, is complete. But on top of that, we have the very aggressive plus aggressive Fed plus, well, being led by what? Sticky wage growth and inertial inflation, meaning the Fed is unlikely to U-turn anytime soon, meaning we're likely to go through the next phase. The next phase is the earnings recession, the EPS recession. We're going to talk about how much of a decline we could face and how long it might take to experience it. On this particular chart, you could see that Credit Suisse argues that the gray line here, or earnings revisions, have not yet actually occurred to drive equity performance into the territory here. That is, usually in recessions, we would expect to see equity performance decline to below this line here, implying we still have quite a ways to go. And in this, we'll talk about their research suggesting how far that is and how long that's going to take. In fact, we're going to start talking about that right now, right after I mentioned that today, over 30 new lectures are being posted in our courses on building your wealth. Imagine 30 detailed style YouTube videos providing you more education on how to build your wealth, whether it's in real estate sales, real estate investing, in stocks and psychology of money, and building your wealth, and trying to think of some different scenarios for building wealth depending on where you are in life or where other people are in life as a teaching example. We also have 4 fundamental analysis streams that were posted just this week where we do some fundamental analysis together. Folks, go to metkevin.com/join and take advantage of that coupon code before it expires because the price goes up regularly. So folks, now the big question, how long coupled with how much more so that we can try to understand a potential bottom. Now, Credit Suisse tells us that the average decline in forward estimates for the last 4 recessions based on international brokerage estimates has been 22%. And the average decline in earnings is 19%, going all the way back to World War II. Now, we believe that the earnings decline could actually be worse, though, because profit margins at companies are starting at such a higher level today because they've had so much pricing power. And so, what does that mean in terms of how much Credit Suisse says we have ahead, how much damage we have ahead, and how long this will take? Well, they argue that the trough will come 4 months before the trough in earnings, and earnings downgrade cycles tend to last 19 months. So let's think about that for a moment. If right now we are here, then that means we have a potential. We have not seen any earnings downgrades yet. We have a potential of having to wait 19 months. Unfortunately, right now, we're in the 7th month of 2022, which means we might not see the trough of earnings revisions until April of 2024. However, we tend to see a bottom of the market 4 months before that, which would actually then come right at the end of 2023 and the start of 2024. In this particular chart, Credit Suisse warns that it's very common after this trough to take 2 to 3 years to return to normal. As a result, Credit Suisse argues that we could see anywhere between a 15 to 20% additional decline in markets between now and the bottom, which is likely to occur, in their opinion, in 2023, likely towards the end of 2023. Now, anytime we talk about pain in the stock market, we oftentimes like to talk about opportunities. This is why we do so much fundamental analysis in our course member live streams that occur every day that the market is open, which you can get lifetime access to the courses, and any of the courses come with live streams via the link down below. But take a look at this. Here's a Credit Suisse suggestion of potentially dangerous stocks because they have what they consider elevated margins. And I took the liberty of highlighting a few here, though of course you can pause and screenshot this yourself. You've got Airbnb, Costco, Domino's, Pinterest, Spotify, and Whirlpool. You even got Teladoc in there. And what I thought was interesting about this was a lot of these were actually companies that did substantially well during the pandemic. These are almost considered stay-at-home plays, right? Or get away from hotel plays. Then they mentioned that here are some stocks with margins below their norm, and companies with margins below their norm they recommended as Carnival Cruise Lines, CVS Health, Disney, Norwegian Cruise Lines, and Royal Caribbean. Now, I thought this was quite interesting because I'm a big fan of taking advantage of, even if we have pain for the next year, taking advantage of the fact that, hey, if the market wants to do this crazy bottoming process, and let's say we're here and maybe we do have an additional 15 to 20% decline, which may or may not be true. Credit Suisse believes this, but that doesn't mean that they're going to be right. In this case, I'd rather be spending as much money as I can in this area here, buying high quality companies that I believe are going to survive the earnings recession. And this is why we've created a new M1 Finance pie that we're sharing with course members, and we're going to talk about a lot this upcoming week with course members about why certain choices are in that pie and why others aren't. It's a diversified basket of about 20 different stocks. We even got an index in there, which we'll reveal in the future which index that is. With that said, thank you so much for watching this video. Consider sharing it if you found it helpful. Consider subscribing. What do you think about what Credit Suisse says? When and how much further do we have to go to bottom? And have a great weekend.